All right, good morning, everybody. Today we are going to be, welcome to our very first Real Access Pro Ask the Pro guest series. And on today's call, we have Dr. Gary Lacefield. Dr. Lacefield is the president of Risk Mitigation Group based out of Arlington, Texas. And Dr. Lacefield has actually both a bachelor's of business administration and a master's of business administration from the Dallas Baptist University and a doctorate in supervision, administration, and conflict resolution from the Texas A&M University at Commerce. Now, for the past 35 years, Dr. Lacefield has worked both in the federal and private sectors regarding financial regulatory related issues. During this time, my friend Dr. Lacefield was a supervisor of lending investigations for the U.S. Department of HUD in the Southwest region and in Washington, D.C. for nearly 10 years. In addition, Dr. Lacefield has served as an executive over compliance and quality control for 2 nationally recognized lenders for 11 years. Dr. Lacefield has also testified as an expert in over 75 cases in both the federal and state courts on behalf of industry, consumers, and for the prosecution. Dr. Lacefield's opinions have been published in the Federal Register and in concurrence with the HUD General Counsel regarding RESPA-related issues. You might also want to know that Dr. Lacefield is a clinical associate professor on the faculty of University of Texas at Arlington, and he also serves on several nonprofit boards. Dr. Lacefield has 4 grown children and, as he says, 8.5 grandchildren. So what we're going to talk about today is, hang on here just a minute, is three to four major topics. We're going to talk about, Dr. Lacefield is going to talk about the qualified mortgage rule and the required use rule, and they kind of go hand in hand a little bit. The new rules on the consumer's ability to pay for qualified mortgages, and of course the enforcement of this. So at this point in time, Dr. Gary, welcome to our program. Thank you very much for being our very first inaugural Ask the Pro and our RESPA Pro, and I'm pretty much going to let you take it from here.
Well, I appreciate that. Thank you very much, and thank you for the opportunity to participate in this inaugural event that I can see the relationship going forward for decades beyond this. Because anytime you've got the government involved in rulemaking and then trying to enforce something that they really don't have a whole lot of knowledge about what they're doing, then you're going to find yourselves and ourselves in situations such as this. And I could talk bad about the government because I worked for HUD, as was mentioned, for 10 years as a supervisor of lending investigations. And so being a former HUDite, then I can certainly share with you what the anticipation is and of what's going to happen with the enforcement. And let's just go ahead and start with that. We're going to be talking about a lot of RESPA-related issues, and under RESPA-related issues, which is now no longer being enforced by HUD, but is being enforced by the CFPB. The CFPB is the Consumer Finance Protection Bureau, and you need to become very upfront and familiar with that organization because they not only have taken over the enforcement of RESPA from HUD, but they are also the enforcing arm for all of the consumer activities for all of the federal agencies now, including the Office of Comptroller of Currency, the former OT, Office of Thrift Supervision, the FDIC, the FFIEC, and pretty much any acronym that has a regulatory attachment to it. Then the CFPB has been created as a standalone agency that is really governed by nobody. Their funds come from the Treasury Department. They actually fall under the Treasury Department, along with the Secret Service and those type agencies. And so lots of times when the CFPB is conducting an investigation, then the investigators that you're going to have the pleasure to meet are going to be Secret Service agents. And so these folks absolutely know how to conduct an investigation, but they may not know that there's two G's in mortgage. And so that's why we're here to help them. And so, don't be afeared. That's a doctoral term. Don't be afraid that when they come in because lots of times they're there simply because they're conducting an audit and there has not been any complaints filed. They absolutely do not have to have a complaint filed in order to come in and do an audit or a review of your operation. So with that being said, and I familiarized you with the CFPB, the Consumer Finance Protection Bureau, let's talk about 3 areas of concern that is really going to impact everybody in the settlement service industry, from real estate agents, brokers, to mortgage bankers, title companies, home warranty and repair companies, and so forth. Those 3 issues, as was mentioned at the top of the program, was the ability to pay, and it was actually titled by some as the ability to repay, but they've designated as ATP, ability to pay. ATP is their acronym, ATP, and actually they're not even being consistent with that, because there are under the CFPB rules they're calling it ATP, but under the rules of the Safe Housing Act that was passed, they call it ATR. So whether it's ability to repay or the ability to pay, those 2 acronyms are synonymous with each other. The second point would be qualified mortgage, and why is a qualified mortgage important to us? I'll explain that in just a moment. And then the third issue is the required use rules. The required use rules, and I'm going to start off with that first, because a lot of people are confused by what that really means and what the purpose of the required use is. Well, to start off with, under RESPA, if you had an affiliated business arrangement, or under the old guidelines, a CBA, a controlled business arrangement, then you could have a relationship with another settlement service provider. So if you were a lender, you could have a relationship with a realtor could have a relationship with a title company, and so on and so forth. And you would have to disclose those under an affiliated business arrangement disclosure. Okay. Well, under the old rules, and the rules that are actually in effect right now, is that the only way that you could force somebody to use your preferred provider, whether it be a real estate agent or a lender or broker, whatever it is, and typically this comes from developers. This comes from the construction, developing industry, where they say, if you use my mortgage company or if you use my title company, then we will give you an inducement or some type of compensation towards your home, typically an upgrade in home, or additions, or something that would be what is now really considered an inducement to purchase. But we'll talk about that, inducement to purchase, at a later time, because it's very involved, and it involves the different rules by all the different investors. And the different investors I'm talking about would be Fannie, Freddie, B of A, Wells Fargo, and so forth. So we have this rule in place that's called required use. And under the old rule, required use is that, if you owned or controlled, if you owned or had an ownership interest controlled the settlement service provider that you were wanting the consumer to use in order to get the advantage, then under the old rules, that was never enforced, or rarely enforced, was that you had to have an ownership interest, that you had to have a controlling interest in that preferred entity that you're required to be using. Okay, but hardly anybody enforced it. Okay, so now what under the proposed rule that the CFPB has the ability to do, they have gotten past this new required use rule, and this required use rule says that if you offer up an incentive or an inducement of any kind, let's say, for example, you offered up a $2,500 upgrade in your landscaping if you use my preferred mortgage company. Well, now if the consumer, so now the rule is that if the consumer does not want to use your preferred lender or preferred title company or preferred home warranty company or preferred fill in the settlement service blank there, then, and they want to use somebody else, then whoever's offering up the inducement, and in most cases it's a builder developer, they have to honor that with whomever the consumer chooses. Now think about that for a moment. If you advertise an inducement predicated upon the fact that you're going to use a preferred mortgage company or a preferred title company or preferred whatever, then if the consumer chooses not to use your preferred whomever, then you still have to honor the inducement. You still have to honor that. Now, that rule has been passed. It's in effect, but it won't be enforced until the CFPB comes out with the guidelines for enforcement, the guidelines for how they're going to measure it and so forth. They are anticipating having those rules come out in July. Now, that's like the 10th time they've pushed that out forward. So I would not be shocked if it doesn't happen until the end of the year. But just be aware that that is out there, and that when they flip the switch and say, here's how we're going to enforce this, then they can certainly go back retroactively and start enforcing it. And that law has been in effect since the end of last year. So just be aware of that, especially if you are in a position where you're in a situation where the builder or developer requires that the consumer use a certain entity in order to get the upgrade. So that's the required use rule, and that is going to put the world on its head. Yes, sir.
So let me jump in there really quickly and make sure that everybody understands. This required use rule, although it's not going to be enforced immediately out of the gate, it could be enforced, if I understand what you're saying, it could be enforced later in the future, but it could go back in time. Is that what you're saying?
That's what the CFPB is saying. That's not what I'm saying. Yeah, the CFPB is saying that there is no, that we are not giving, and this is a quote, we are not giving a safe harbor to entities that are violating the rule now. We are not giving a safe harbor. Now, that doesn't mean that they're going to go back retroactively. That certainly is the implication, which is pretty scary.
Yeah, that's scary in and of itself. Absolutely.
But from my standpoint, that just guarantees future business for me. So anyway, that's beside the point. Okay, so that's the required use, and once again, you know, that's going to be something where the builders and developers are going to believe that they don't have to comply with that, just like builders and developers didn't believe that they had to require with RESPA, because they're not a named entity. They're not a named in the Real Estate Settlement Procedures Act. You know, they're not named as a real estate agent or a broker or a title company or home warranty, any of those. But there's a little caveat in RESPA that says, underneath, after all of those, if you're not a broker, lender, whatever it is, that if you're in a position to refer settlement services, then you're covered. And who is not in a better position to refer settlement services than a builder or developer? And so that was a hard lesson for them to learn, especially up in, there's a case called the Tulsa Five, which were 5 builder developers up in Tulsa, Oklahoma, and you can Google this. It's HUD. This was back when HUD enforced the rule, and it cost those builders and developers, the Tulsa Five, several $1 million in fines, and then they ultimately ended up suing their own legal counsel for misrepresentation, because it was their counsel that told them that, you know, they weren't covered under this. They didn't have to comply with the RESPA guidelines. So anyway, there's a long history, and I could talk hours and hours and hours about different cases that I've worked on while at HUD and since HUD about issues dealing with affiliated business arrangements and required use. And on a future program, we're actually going to talk about what are the 10-point steps that you would need to be aware of if you were going to come up with or establish a legal, safe-proof, RESPA-proof, CFPB-proof agreement between yourself and any other settlement service provider. But once again, that'll be the 10 rules. That'll be something coming down the pike a little bit later that is already in effect. The second topic I'd like to talk about is this qualified mortgage and either the ATR or the ATP, depends on what document from the CFPB you look at. I mean, they can't even get together on what they're going to term this rule, either the ability to repay or the ability to pay. So anyway, they really kind of go hand in hand. So let's start with what a qualified mortgage is and why that's important to you, whether you're a real estate agent or you're a lender or a real estate broker. A qualified mortgage is important because if a loan does not meet, quote, the qualified mortgage terms, and the qualified mortgage terms basically means that if this is a qualified mortgage, then number one, it's not a high-cost mortgage. Number two is that the consumer is putting, say, it has a low LTV, so putting 20% down. Other terms of a qualified mortgage would be that their debt-to-income ratios meet a certain minimal criteria, and by minimal that means that it can't exceed the front end and the back end ratios can't exceed certain thresholds, which they're still working on that, and they still haven't really identified what those ratios are going to be. So a qualified mortgage means that the consumer is going to be qualified to repay that mortgage under all of those other conditions. Now, loans that right now are FHA loans don't have to meet the QM guidelines. They're exempt from that. They're also working on exemptions for Fannie and Freddie. And can we hold on just a moment? Let's hold on for just a moment.
Absolutely. And so we're going to take just a very quick break. Dr. Gary's actually got to go answer the door real quick. He kind of let me know of this. So, and you know, again, guys, this is our new Ask the Pro series. We're actually going to have on our website www.realaccesspro.com where we have the Ask the Pro series, and we have a marketing pro. If you've got marketing questions about how to market, what's the best way to market, or some marketing ideas, go there. You know, our Ask the Pro or Ask the RESPA Pro, well, that's going to be Dr. Gary. And if you've got questions that you'd like to get answered, kind of like a syndicated column type deal, then go ahead and submit your questions to Ask the Pro at realaccesspro.com. And we'll get those questions answered in just as quickly as we can because, again, you know, Dr. Gary does own a company, and he does teach 5 classes a week, so he's pretty busy. We're also going to have Ask the Attorney. That's going to be dealing mostly with our foreclosure defense attorneys. What are, you know, things dealing around with modification, credit, things like that, and so on and so forth. And we're going to have a couple of other. And if you've got ideas as to different pros that you'd like to have on, by all means, go ahead and email us. Again, the email is going to be askthepro@realaccesspro.com. You can go ahead and submit your questions there. And as I said, we'll answer them just as quickly as I can. And Dr. Gary, are you back yet?
I am back and ready to roll.
Okay.
So as we started to talk about what the issues were with the qualified mortgage, and the reason that if a loan other than FHA and they're trying to get, I think they're close to getting Fannie and Freddie direct loans that would not be covered under this act, but right now it's just FHA that's exempt. But these qualified mortgages, if a loan does not meet the QM standard, that means that the debt-to-income ratios are too high. If the LTV is not low enough, then what's going to happen is that loan does not meet the QM standards, and so that the lender who originates that loan, and then when they sell that loan, whoever then purchase that loan, both of these entities have to maintain a, quote, reserve, a percentage of that loan amount in reserve until that loan is gone, until that loan is no longer under their control. And so that's going to cause lenders and investors to have to have these massive reserves that cannot be collateralized based on these terms of a, quote, unqualified mortgage. And so that's why they're going to strive for qualified mortgages or push to have mortgages through other means. And so right now you've got probably a limited, as we have at all times, we have a limited number of folks that have the ability to put 20% down on a mortgage. So
can I jump in and
sure.
Ask a question? We've got a question coming in from Jim, and he's asking, does this mean, or do you anticipate that A, it's going to be harder for people to get mortgages, and B, do you anticipate that rates are going to increase dramatically?
Yes and yes. Now, right now, let's talk about the latter first, where you have the rates are probably at their lowest of all time right now. But those will start going up once these rules go into place. All of these rules go into place that we're talking about with the qualified mortgage and the ability to repay or the ability to pay take effect January 2014. And so you're going to have a lot of scrambling. You're going to have a big push to do loans and so forth during that time, especially towards the end of the year. And then you're going to have issues with underwriting, because here's the big factor is that, yes, it's going to be much more difficult come January 2014 to get a loan. Okay? But right now, the way that the rules and guidelines are set up is nobody knows how to follow them. I don't know how to follow them, and I've read the rules probably a dozen times. I've sent messages to the CFPB, and I get different answers. And let me give you an example of this. And we're moving on to the third topic now, which is the ability to pay or the ability to repay. Under these guidelines, under Section 9 of these, that's Roman numeral 9, which is what everything is relying upon, because this all came from basically from the SAFE Act, and this is what the CFPB's interpretation is of these rules to identify what is considered debt to income. Well, the income rules are pretty simple. If your income is considered to be coming in on a regular basis, just like we've always considered income, there's really no change in those standards. However, under Title IX of these rules, and the question is, and by the way, one of the things that at the end of the program, I have two documents here. One's called the CFPB Ability to Repay and Qualified Mortgage Rule, as it stands as of April the 10th, 2013. And also, we're also sending you the 8 new rules navigating the CFPB's mortgage requirements. Now, read those. Don't put them to memory, because that's all in flux. It's all changing as it goes. But it is a starting point. Now, the CFPB has made a statement that, and this statement was as recently as Monday of this week, that said that the rules that they have in place, these 2 guidelines that I've mentioned that we're going to give you the opportunity to download, is they believe that it's clear enough. Okay, but they're entertaining questions about how to respond to this. And the one particular topic I'm going to talk about on this ability to repay is how do you calculate the debt in the debt to income ratio. Okay, now under the old rules, under the when we used the automated underwriting systems, and we placed into effect your mortgage payment and your rental payments and whatever those other payments might be, your credit card, your minimum monthly payment on your credit card debts, those types of things, your car loan, Those things that are fairly standard that we've relied on since 1988 in these automated underwriting systems in order to do a fair calculation. And by fair, I'm talking about so that everybody is treated the same. The whole reason automated underwriting systems were created in the beginning anyway is because HUD passed the Fair Housing Act of 1988 that went into effect April 13th of the following year. And in that, there were several hundred lawsuits filed against lenders because they were making reasonable or sound financial decisions about who to loan money to based upon their debt-to-income ratios and so forth. The automated underwriting systems kind of simplified that so that if you plug these numbers in for everybody, then everybody would qualify for this same type of information, same type of loan amount, same type of rate, and so forth. Well, and I'm just going to read this for you. This is on how to calculate the debt. Okay, and this is in the rules, and this is on page 20 of the document that we're sending you that says ability to repay and qualified mortgage use. And this comes out of Title IX, which says, what do I include on my debt side of my debt-to-income ratio? Well, it says, 1, the loan you're underwriting. Okay, well, duh. Next is any simultaneous loans secured by the same property. So if there's any other loans attached to that, like maybe a second lien. Any mortgage-related obligations, property taxes, insurance required by the creditor, any fees owed to a condominium, cooperative or homeowners associations, ground rent or leasehold payments, and special assessments. All of these things are standard things. These are the things that we have done and considered as debts since the beginning of time to calculate whether somebody's qualified or not to repay the debt. Paragraph 4 states if you have any current debt obligations, alimony, and child support. Okay, understandable, which we also considered those. But now here it says once you have the total debt figure, you will use it along with the consumer's total monthly income to calculate monthly debt. Then there's a note that says include in your debts ongoing required monthly, quarterly, or annual debts of the consumer. Okay, well, let me read that again. You need to include ongoing required monthly, quarterly, or annual debts of the consumer. Now, what is it, the debts that we all have ongoing every month? We have our utility payments. We have our satellite contracts. We have our cell phone agreements. We have
car insurance.
Car insurance. There you go. And it goes on.
We have our internet. We have our internet bill. So you're telling me now. So the way that I understand this is that the utilities, other than what's on my credit report, which it has been standard for quite a number of years, at least since all the number of years I've been in. But now my utilities, anything I'm making a monthly payment on. But here's a good question that Isabel is asking. What about deferred student loans? There's a lot of banks out there that will not take into account, and I've heard it on both sides. They shouldn't take into account, student loan payments. You've just gotten out of school. You've gotten a house. You've got 6 months to a year, maybe longer, before you have to pay your student loans. And then on the flip side of that, Larry is asking, what about situations of child support that you're receiving, or Social Security that you're receiving, or alimony that you're receiving, but it might be on, it might not, it's not going to continue forever. The average house payment lasts for 30 years, whereas child support only lasts for at the most, what 21, 23 years in most states. So if you can you comment on those two questions?
Well, I can, and that goes back to the 2 phone calls that I made to the CFPB. I spoke to 2 different individuals, and I only called 30 minutes apart. And my simple question was, and I just wanted to focus on utility payments, because everybody's got utility payments. Okay? The first person told me that, well, it depends upon what your utility payment is that month, and that's what's supposed to be calculated in. Well, that's going to make a, and I said, well, you know, your utility payment's going to be different in January than it is in July, especially in Texas. You know, I mean, thinking about my own, where my electric bill is about $120 in the wintertime, but it gets up to the $400 or $500 range in the summertime. Okay, and so that didn't sound like a very reasonable response, and so I challenged him on it, and he said it says the rule is very clear, like I'm an idiot, and he says that it says it's what your current monthly debts are at that time. Okay, that is what it says, but, and so then I call back a little bit later to see, ask the same question, different person, different CFPB person answered the phone, and he said, well, on utility payments, the way that that he is going to enforce that is he's going to take, because you, on your utility payments like electric bill, you can get the last 12 months history, that kind of thing. And I said, well, what if you're buying a new house and you don't have a 12-month history? Then you can get a statement from the utility company claiming or stating what they anticipate what your monthly utility bill is going to be. I said, well, okay, that kind of seems a little more reasonable, but that's still not going to, if you've been living in an apartment and your utility bill is part of your payment of your monthly rent and it's never been separated out, and now you're going to live into a you know, a 1,500 square foot house, you have no idea what the utility payment is going to be, and I doubt that the electric company is going to know. But anyway, once again, that's just talking about utility payments. Now, talking about the deferred payment on the education and so forth. Here's what I understand, and this is from a conference that I went to, talking to CFPB people. It says that if it's, and once again, they're using this term, ongoing, required monthly, quarterly, or an annual debt of the consumer. If that deferred payment is going to start within any time within the next 12 months, it's got to be considered as part of a debt, because it would be considered an annual payment. Okay? So if the deferment is going to start any time within 12 months of the origination of the loan, then that whatever that monthly payment is going to be, that deferment is agreed upon, it will have to be included in the debt-to-income ratios. And what we're really talking about here is, especially when we're talking about cell phone bills and automobile insurance and all of those types of things. For example, I pay my automobile insurance on a 6-month basis. So the cost to me for insurance is let's just say it's $680 every 6 months. Okay, the same individual who pays it on a monthly basis, their monthly payment on insurance is going to amortize out to about $900 for every 6 months. So they're going to be paying more. And so once again, just like anything else, there will be impacted greater simply because of the way they pay their automobile insurance or their health insurance or their life insurance or all of these things. And so then, especially in cell phone bills, you've got your cell phone that, depending on what your contract is, I got a great deal. I got it several years ago, and I've maintained it. So I have worldwide international use, and it's $100 a month. No roaming charges and so forth. But most other people are maybe spending $200 or $300 or $400 a month on their cell phone bills. And so all of this falls into the category of lifestyle. So now what the feds, the CFPB, are saying is that we're not going to give you a loan unless you qualify based upon your, quote, lifestyle. Okay? So now that means that there's going to have to be a way for the lender to quantify these lifestyle issues, okay, which is going to be a direct impact on realtors and real estate brokers. Okay, so right now they have not. They think it's clarified enough. I think it's very confusing and misleading, and I think it's set up as a lot of rules are set up, is that it will be next to impossible for you right now as a lender to comply with these rules as they're set out. Okay. Now, let me throw another another wrench in this mess. Under the Fair Housing Act, it is illegal to discriminate against somebody based upon their lifestyle, based upon whether they use too much of this or not enough of that or so forth. And so if you're treating people differently based upon, quote, their lifestyles, then the lenders are going to find themselves in as much trouble as they were prior to 1988 when they amended the Fair Housing Act. So those are the issues, and that's what we know about these things as of right now. The CFPB has actually put out a couple of notices talking about that they're going to be very active in enforcing the fair housing, fair lending laws. So it's going to be, if you comply on one hand, you're probably going to be violating something on the other hand.
Well, that kind of opens up a question here at this point, and this question comes from Daryl, and Daryl's asking, let me make sure I can understand how he's asking this. Hang on here a minute, I'm trying to understand it. Well, you know what, Daryl, let me just hold off on that for just a quick second, or maybe we'll write that down and actually get a little bit more clarification on that for you, sir, so if you don't mind. So we'll just continue with Dr. Gary here.
Well, those are the main issues that I wanted to lay out on the table. That really, if we talk about the required use rule, and let me just summarize that real quick. Under the required use rule, the law is in effect, but they're not going to start enforcing it until they actually lay out the guidelines on how everyone is supposed to comply with it and how they're going to investigate it. And so they're saying that could come as early as July. It may come as late as October, November. Okay, that's rule one. Rule two is this qualified mortgage, and once again, if lenders are less likely to do a loan that's outside the parameters of a QM or a qualified mortgage, simply because they don't want to be put in a position to have to set aside reserves and set aside money that they're not going to have any access to during the life of this loan, during the life of the loan that they have any association with. And then third is the ATP or ATR, either ability to repay or ability to pay guidelines, which the income portion is very clear. The debt portion is about as clear as muddy water. So with that, if there are any other questions, I'll be happy to field them.
Well, the question I think that what Daryl's asking is, and you kind of led to this earlier, is changes. I guess the CFPB and all the regulatory agencies involved are taking. I guess the best way would, taking public hearings, not really public hearings, but that's about the best way I can say it. If somebody if a real estate agent or somebody in the general public wants to come and make a request or say, you know what, just like you said about, being in compliance with one rule, makes a lender or a real estate agent out of compliance with another rule, how does somebody, submit their thoughts or ideas or questions or concerns? How does somebody submit that information? To whom do they submit it? Is it email? Is it a phone call? Is it calling your congressman? Do you have any feedback for our listeners and our viewers on that?
I do. If you have any comments about the CFPB rules, you can, their website, actually their contact information is going to be on the first document that you'll have access to, and that's entitled The Ability to Repay and Qualified Mortgage Rule. And it actually has a website, a link that you can go on and ask a question and or file a complaint if you believe that whoever you're dealing with is violating any of these rules from a consumer standpoint. And by the way, when I was at HUD and dealing with RESPA complaints, 99.9% of all of the complaints came from industry. It came from your competition. You're the ones filing the complaints, not consumers, because consumers could really care less about this stuff. You know, I mean, there's no consumer or consumers, except for myself, going to sit and read a 1,500-page rule that covers one little aspect of what we're talking about, and we are talking about the 1,500-page document on this qualified mortgage rule. But as we move forward with this Ask a Pro, I'll information as it becomes readily available. But please remember, don't shoot the messenger. All I'm doing is putting the information out there that is as the CFPB is stating it. Now, come January 1st, and when the first week of January, when they start enforcing this and taking action, they will already have a favored list of people that they're going to, or entities that they're going to go after, because they're already monitoring what they're doing. They already have complaints in the system for what they're doing, and going on from there. Now, one of the other things about going along the lines with filing a complaint, on that website, the CFPB has made available to the public all of the entities and the number of complaints filed against those entities. So it's kind of like a Better Business Bureau kind of thing, except for, once again, you've got to take that with a grain of salt, because just because a complaint's been filed against a certain entity, it doesn't mean that there's any validity to it. It doesn't mean that it's being pursued. It doesn't mean that the people have done anything wrong. The way the CFPB is set up, it's set up just like HUD was set up, or still is set up. If you want to file a fair housing complaint with HUD, the agency has to take it, regardless of the merits, regardless of if anything really happened. And then, of course, then they do their inquiry, and then they go from there and decide whether or not they should issue a formal complaint. And so the CFPB is under the same type of guidance, where if somebody files a complaint, then they're going to accept it and then vet it out later. But the information that we're going to send you will have a link to, we'll have the phone numbers for the CFPB. We'll also have the link to where you can contact the CFPB to either inquire about an issue or to file a complaint. You can file a complaint online with the CFPB. Now, one other caveat that I'd like to mention is that just like if you call during tax time, which hopefully everybody filed their taxes on time, is that if you talk to an IRS agent and they give you a piece of advice, there's always a disclaimer on there that says that even though we're telling you what to do, you can't hold us accountable if you violate the law. Same thing with the CFPB. If the CFPB investigator tells you that this is what you need to do, that's not a safe haven. It's not a safe harbor.
So the safe haven, the safe haven would be to hire Dr. Lacefield and include him on your staff, and of course he's always open to that, I would assume, as his time allows. And if you've got questions or specific questions, or you need more specific advice, make sure that you reach out to him. Again, he's the president, owner, CEO, founder, genius, as I would say, of riskmitigation.net. And again, we're going to have that information down below this recording here. So that would be one way to get more, a lot more accurate information on a more timely manner. Would you agree with that?
Yeah, yes, sir. Except for, I don't think anybody out there can truly be a safe harbor. All we can do is help you mitigate any potential liability. That's what our company is. It's a risk mitigation group. So we mitigate the risk for you conducting your day-to-day business. And our primary goal, and this is our stated goal for admission, is that we're here to help you keep the money you've already earned. We're here to help you keep the money that you've already earned. So, and with that, do you have any other questions or any other questions out there?
I pretty much don't, but like I said, guys, this is our inaugural Ask the Pro series. If you've got questions, pointed questions that you'd like to have answered, just go ahead and submit them. Again, submit them to the email address of askthepro@realaccesspro.com, and they'll be forwarded out to the appropriate individual. And if we don't have an individual, we'll find somebody for you. We're going to have somebody on goal setting in May, and in June we're actually going to be talking with the builder, and we're going to kind of talk about the builder and real estate agent relationship that they have, how one helps the other, along with some other upcoming ideas. And if you have ideas for our series, go ahead again, submit them to us, and we'll take it from there. But other than that, make sure that you check in with our webpage. That's realaccesspro.com. Also on our Facebook, we'll have a couple out there, but most of the questions and comments and the questions and answers that we're going to get are going to be on Real Access Pro under the Ask the Pro series. So, Mr. Gary, I really, really appreciate you taking the time out to speak with our